Indicators. Traders from all walks of life use them to help gauge where the price of a stock is going next. One of the most popular in the world right now is the Relative Strength Index, commonly referred to as RSI. Classified as a momentum indicator, RSI is displayed on charts as an oscillator, a line graph that moves between two extremes. You've probably seen these types of charts before, and they usually read from 0 to 100. So what is RSI and how can it help you trade? Well, in essence, relative strength compares the bullish and bearish price momentum, helping you evaluate whether a stock is overvalued or undervalued. If a stock is overbought or overvalued, it's usually in a state where it's ready to reverse its trend and correct back or pull back in price. If you're reading RSI based on the common traditional interpretations, any security that has an RSI value of above 70 is considered overvalued or overbought. On the other hand, if the RSI is under 30, it's considered oversold or undervalued, primed for a trend reversal up. Now, of course, if everything in the stock market operated based on this oscillator alone, we would all be rich. You have to remember that this is an indicator to help you. It will not predict trends and movements 100% of the time. In order to help you understand it, we can dig into the math. The formula for RSI is relatively simple, but explaining it would take a video 5 times longer than this. To spare you the boredom, the RSI calculation is largely based on the average upward or downward change within a given look-back period. There is much more to this story with other processes like smoothing involved, but understand that in essence, RSI looks at trends within a certain time frame. The most commonly used time frame or look-back period is 14, representing the last 14 trading days. The shorter the time frame, the shorter the outlook. The longer the time frame, the longer the outlook. Traders will often use RSI in conjunction with a short-term moving average. For an example, many will plot a 10-day and a 25-day moving average line. When these two lines distinctly cross over, that indicates a shift in price direction. Oftentimes, if you take a look at the RSI during these trend reversals, you will see that the numbers are in the 20 to 30 range, or maybe even the 70 to 80 range, showing overbought or oversold readings. Simply put, RSI forecasts sooner than almost anything else an upcoming reversal or a trend either up or down. There are many more specific examples of how traders use RSI in a variety of situations. One of the most popular is a bullish divergence. This occurs when the RSI creates an oversold reading followed by a higher low that matches correspondingly lower lows in the price. This indicates rising bullish momentum, and a break above oversold territory could be used to trigger a new long position. On the other hand, a bearish divergence occurs when the RSI creates an overbought reading, followed by a lower high that matches corresponding higher highs on the price. As you can see in the following chart, a bullish divergence was identified when the RSI formed higher lows as the price formed lower lows. This was a valid signal, but divergences can be rare when a stock is in a stable long-term trend. Using a flexible oversold and overbought reading will help you identify more valid signals than would otherwise be apparent. You can read about many more of these specific examples if you head to Investopedia.com and just read their article on RSI. In summary though, use RSI anytime you're struggling with a decision to sell or buy. This indicator will help you enhance those decisions with real data and valuable insight.